Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Yeah, well, thanks everybody for joining us today. My name is Will Simons. It's a pleasure to be with you virtually. I'm going to say hello, do my kind of intro here on camera, but I'll turn the camera off for most of the class just so everybody can focus on the slide material that we have for you today. Before I move on, Ashley, thank you very much for all the work that you do putting this on. Thanks to everybody at Campbell. We've been doing these now for at least a couple of years, and we always get a great turnout, and I really appreciate the opportunity. So thank you very much for doing that. As Ashley mentioned, today's class is called Fundamentals of Reserves. Class should run for just about an hour, and then we'll have time for Q&A at the end. Usually we have, I would say almost always, we have more questions than we have time to answer them. So I'll do my best to get through those as much as we can. Feel free to submit those questions using that Q&A taskbar on the Zoom chat during the course of the material here. So just, I guess, one more housekeeping note. Our company will be submitting the course credit for today. So everybody should have provided their CAM license number as part of the registration. You don't need to email that in to us. If you've already done that, then we have that on file. If you don't see the credits posting within the next week or two, then feel free to reach out and we'll be able to resubmit it. But if you are a licensed CAM, then we should have everything on file for you already. So let me dive into a little bit more detail. As I said, my name is Will Simons. I'm the president of the Florida office for my company. It's called Association Reserves. I've been with the company since 2008, spent most of my career in Florida. I've had clients in Florida going back to the early 1990s. In case you're wondering, the RS after my name stands for Reserve Specialist, which is the signature credential for people in our field who have demonstrated their experience and expertise in preparing reserve studies. If you're familiar with CAI, the Community Associations Institute, that is who awards that designation. Personally, I've lived in both condos and HOAs, so whichever type of community you're representing today, we have a lot of familiarity with your particular needs. I used to be on the board of my HOA, did about 6 years on the board there. I was the treasurer, oversaw a budget of about $1 million. I think we had 600 plus homes in our community. So I do know what it's like to be on the other side of the table. I know that being a board member can be a thankless job. Even being a property manager can be a thankless job at times. So I tip my cap to you guys who are out there doing this every day and taking this time out of your day today to join us and learn a little bit more about reserves and reserve studies. And my hope is that this information will help you out a great deal. So I'll talk a little bit about our company. So Association Reserves is the oldest and largest reserve study provider in the US. We've been in business since 1986. And we've completed tens of thousands. I think I need to update our slides now, actually, because we have 13 offices, having just opened one in Ohio this past year. We've done thousands of reserve studies for all different types of properties all around the world. We've got offices from coast to coast. We actually, I believe we have more credentialed reserve specialists on staff than any other company. The majority of the work that we do is for community associations, of course, all types of condos, HOAs, but also timeshare, vacation ownership properties and other residential communities. We also have a great deal of experience with other properties. So if you happen to be on the board of a church or a school or a not-for-profit, we've got lots and lots of experience working with other types of common interest real estate developments. Really, the fundamental skill set of doing a reserve study can apply to almost any type of property. So we're here to help you. We actually need to update our slides again. We've now got 10 consecutive Reader's Choice Awards with the Florida Community Association Journal. So we're very, very proud of that and very thankful to our clients and our readers who have voted for us in that annual competition. I always like to point out that our only job as a company is preparing reserve studies. We're not an engineering firm. We're not an accounting firm. We are a very specialized consulting company that does this one thing really well, which is to guide our clients towards a successful financial future. The way that we do that is by preparing these accurate, reliable reserve studies that help those clients to forecast and budget for major projects. So we feel that if we do our job well and then our clients stick to the plans that we lay out, hopefully the benefit of that is that they're able to reduce the risk of financial stress, typically in the form of special assessments or bank loans. So if you want any more information about our company, you can visit our website, which is reservestudy.com. I'll have my email address up on the screen at the end of the class during the Q&A, but if you want to write that down, it is wsimons, so WSIMONS @reservestudy.com. Okay. I'm going to go ahead and switch the camera off because we're really going to start the material here in a second. So this is basically what we're going to cover today. If you've taken this class before, some of this will be a repeat, but there is some new content that we added last year in the wake of the new Senate legislation, or I should say the Senate Bill 4D, the new legislation that was passed in Florida last May. But in the beginning, we're going to answer kind of this basic question, what are reserves? And then the majority of the class, I would say, is going through the reserve study process, talking about how these documents are used by associations. And then at the end, because I'm already anticipating there will be a lot of questions about it, I'll give a quick overview about Senate Bill 4D. And actually, even now, there's some new information to pass along, which is that there is a new Senate bill that just was filed about 2 or 3 weeks ago, which is Senate Bill 154, which is taking shape as the long-awaited cleanup bill or glitch bill that a lot of us have been talking about for many months now. So exciting stuff going on, but we're going to begin kind of with the basics today. So if you've been in this field for a while, this information is probably going to be pretty elementary, but for your board members out there, newer managers, if you've not been through a budget process before, let's just take a few minutes talking about the two main aspects of any given association's budget. Basically, your budget can be categorized into two sections. You've got your operating fund and then your reserve fund or funds. So first, we'll talk about the operating fund. Now, that money is essentially there for the routine costs of running the business of the association. Okay, these are the daily, weekly, monthly expenses for things like utilities and insurance and payroll, preventive maintenance, just all the ongoing maintenance and operating costs of the association. Sometimes we put this in personal terms. You can think of the operating account for an association, sort of like a checking account for an individual, right? It's just what you use to pay your groceries and your car payment and all the day-to-day costs of running your life. Operating money in an association is unrestricted. That means that that money can be spent on any bill that the association has to pay. That money will typically be spent in the same year that it is collected. So what that means is that if you've designed a really good budget, hopefully you don't have any significant surplus or deficit at the end of the year. You're going to spend all of the money that you collect during that fiscal year in the same year for those ongoing expenses. Now, on the other hand, you've got reserve accounts, and these reserve accounts are there for the long-term expenses that associations have to pay for. Some of these expenses may not occur for 5 or 10 or 25 years at a time, but when they do occur, these can be some of the biggest bills the association will ever have to pay. Okay, so reserve funds are typically going to be used for things like roof replacements, painting a building, pavement resurfacing, concrete restoration, elevator modernization, lots of other big projects we'll get into later on. Some of the other differences between operating and reserve money is that reserve funds are restricted. So what that means is that when you put $1 into a reserve account, it can only be spent on reserve components, right? Not just any bill or fee the association has to pay. Another difference, again, in contrast to our operating account, reserve money will accumulate sometimes over many, many years, building up an account balance until that money needs to be spent for its intended purpose. And so if we go back to that kind of personal finance analogy, you might think of your reserve account more like a savings account or a retirement account would be for an individual. Okay, on this slide, I've included a short section from Florida statutes. This is from statute 718, what we call the condo statute. And what I've highlighted in red here is the portion of the text that talks about what associations must be reserving for. So if you take a look at that section, the statute requires that condo associations reserve for 3 things in particular, and then they add in one general definition. So the 3 things they name specifically are the roofs, painting, and pavement. And then the general catch-all definition is for any other item with a replacement cost greater than $10,000. Now, if you're wondering why did they pick $10,000, that's a good question. I've been teaching this class for many, many years, I think 10, 11 years now. And I've asked this question in front of lots of people, and nobody has ever really come up with a clear, decisive answer as to why that number is $10,000 as opposed to 1,000 or 25,000. And this is the point to make is that, I think when they wrote the statute way back when, decades ago, I think they just picked a number that sounded high and said, okay, let's go with that. But it's kind of arbitrary. For many, many associations out there, I would argue that $10,000 is probably much too high of a threshold to set. So we're going to talk about this a little later in the class, but I want everybody to frame it as, what is a financially significant number to my association? Certainly anything above $10,000, but for some communities out there, that number might need to be a little bit lower. Okay, on this slide here, I've got the portion of the statute that pertains to HOAs. So the HOA statute 720 actually has even less to say about what you should be reserving for in a community association. So unlike the condo statute, the HOA statute does not have any specific checklist of items that need to be included. Instead, pretty much all it says is that there are certain things that associations are responsible for. And if you don't have reserves, that might result in a special assessment. Okay, now, obviously we know that's a bad thing, something to be avoided. But, set aside the statutes for a moment. The good news, and something I want to teach everybody today, is that there is a much more realistic and thorough way to go about defining what any association, condo, HOA, co-op, whatever type of property you've got, whatever they should be including in their reserve plan. Okay, now I'm going to pause here for a moment and just reiterate again, I said this at the top. I'm going to talk about Senate Bill 4D at the end, and they do have a longer checklist of items that would meet the structural integrity reserve study requirements. I'm not going to get into detail on that right now, but I'm sure we'll cover that towards the end of the class. For now, I'm trying to keep this high-level overview and explain to you guys a little bit different methodology, a little open-ended concepts of how to think about this stuff. Okay. So when we talk about reserve money, let's frame it this way. This is money that is there for associations to save over a long period of time for major repair and replacement projects. Now, important to notice here what I did not say, okay? I did not say that you can spend reserve money on capital improvements, on paying your insurance deductible, or really any other purpose. Now, technically, legally speaking, you can use this money for those purposes if it's approved by the majority of the owners, but that does not make it a good idea. That should not be the first option on the table for paying those types of costs. But let me just give you one example. When we talk about capital improvements, that means something that an association is kind of creating out of nowhere. So let's say you've got an association that does not have a playground, but all of the residents get together and they say, look, we've got some open space here. Let's build a playground. Now that might be a very worthwhile thing to do. It might be good for property value, but they should not be using reserve money for that. Okay, that's because it's adding a new element to the association, which would have never been considered in any of their prior year budgets. So that means that any prior reserve contributions, any money that they did put aside, was done so without taking into account this new expense. Okay, so again, that might be a nice idea, a good thing for the community, but building that playground should be paid for some other way, whether that's a surplus in operating, a loan, a line of credit, a bake sale, whatever the methodology is. The point is you don't want to be taking money away from your existing reserve components and using it for something new. That money was kind of spoken for already. Okay, so again, that was short and sweet, probably a review for most of you out there. We're now going to switch gears and talk about reserve studies and how these are used by properties when they are preparing their annual budgets. So first things first, again, almost all of the material I'm going to cover today is kind of rooted in what we call National Reserve Study standards. Now, these standards have been in place for over 20 years, actually 25 years this year, And they define a reserve study as a tool. It's a document, but it's a tool that does a couple of important things. First, it identifies the current status of the reserve fund. And then secondly, it provides a funding plan that gives guidance about how to deal with future expenditures. Okay, so again, notice what I didn't say. A reserve study is not an insurance appraisal. It's not a turnover study. It's not an engineering report. Okay, this is a very specific document that contains very specific content about both the physical and the financial elements of the community. There are 3 types of reserve studies. So if your property has never had one done before, you'll begin with what's called a full reserve study. Sometimes we call that a level 1. So in that type of study, the provider is basically building everything from scratch. Okay, the person's going to come out there, do a thorough site inspection to take measurements, take photos, basically gather up all of the raw data that will eventually become the component list for that property. Now, after that initial full study is done, there are 2 types of update studies that can be done later. The first one is called an update with site visit. In that case, a new site inspection is taking place, but it's using the existing component list, just trying to identify any significant changes in life expectancies or cost estimates based on current conditions of the property or of the financial marketplace. Obviously, we know in the last 2 years or so, costs have changed dramatically across the board for many, many components. Okay, there are some states that require these types of with site visit updates to happen at specific intervals, but generally speaking, best practice is to have one done at least every 3 years or so. Now, that is actually another criticism of the structural integrity reserve study requirement. It would say that it only needs to be done once every 10 years, which is just, quite frankly, that's just not often enough. Things change too dramatically in a short amount of time in Florida to wait 10 years between updates. Okay, the last type of study is called an update with no site visit, which is exactly what it sounds like. It's still a whole new reserve study document, a new financial analysis, just without the benefit of conducting a new inspection. So in those cases, since nobody's coming to the property, in that case, we'll be corresponding with the board or with the manager to find out, hey, since the last time we were there, what projects have you done? Have you gotten any new estimates for anything? Basically try to catch us up on the changes that have taken place since that last time somebody was on site. Okay, there are 2 parts to a reserve study, what we call the physical analysis and then the financial analysis. Now, the physical analysis portion of the study, this is where someone comes out to do that on-site visual inspection of all the common areas of the property. It's everything from the roof to the mechanical rooms, the amenities, the lobby. Basically anything and everything that the association is responsible for should be evaluated. This is going to involve taking lots of measurements, photos, but also documenting model numbers and serial numbers for equipment, meeting with building staff, talking with your chief engineer, basically finding out whatever information we need to gather up all that data related to each component, which will eventually be used to determine the life expectancies and costs for those things. All right, so again, during this physical analysis portion, it is very, very beneficial to have representatives from the property meet with your reserve specialists. So that can be committee members, board members, manager, basically anybody who's got some insight and experience of having lived there or worked there for a long time. That is very helpful information. We definitely encourage all of our clients to think of this as a collaborative process. Okay, the second part of that reserve study is the financial analysis. And this is basically everything that takes place back at our office, back at the computer, where we organize all of that raw data, which came from the inspection, and we start to run different funding scenarios and analyzing the data. This is where we're going to research cost history, project history, compare that information against experiences working with other properties, basically trying to fill in gaps and start to get a bird's eye view on the big financial picture for this community. Okay, there are 3 outcomes to a reserve study, which I'll be going over one at a time. The first outcome, what do you get from a reserve study? First thing is the component list. Now, the word component in this context really just means some instance where the association is going to spend some money. So a reserve component could be a roof replacement, could be a swimming pool resurfacing, it could be a lobby remodel or renovation project. For each component, there are 3 key pieces of information that need to be determined. The first one is the useful life of that component. So what I mean by that is its overall lifespan. In other words, how long is it going to be in place from start to finish, either from when it was originally installed by the builder or from when it was most recently replaced until that needs to be done again. The second estimate is what we call the remaining useful life. Now that number is going to always be determined relative to a certain point in time. So for example, let's say you've got a component with a useful life of 10 years, but as of this fiscal year, it's 3 years old. In that case, you would say that as of this fiscal year, the remaining useful life should be about 7 years. All right, now lastly, we'll come up with an estimate for replacement costs. And I've been asked over the years if the word replacement really matters here, right? So questions come up often in the Q&A. If we're just replacing the compressor on an air conditioning unit, but not buying an entirely new system, can we still use reserves? And I would say in that sort of situation, the answer is yes. You don't always have to be fully replacing something to justify reserve spending for it. You could just as easily say upgrade or remodel, modernize, resurface, or something else. It doesn't always have to be a wholesale replacement. Instead, what you want to do is keep the focus on the need to spend money to keep that component providing its value to the association. All right, so if you're wondering now, how do we determine what goes on the list? I'm going to give you a good overview here. We talked earlier about the Florida statutes and what they have to say with respect to reserve budgeting, but right now I'm going to give you a different approach. All right, most professional reserve study providers will be using this 4-part test, which comes from our National Reserve Study Standards. Now, this is more of an open-ended definition of what a reserve component should be. And the beauty of this 4-part test is that it can be applied to any different type of community. So instead of going into a project with some kind of predetermined checklist, we go in with our eyes open, looking for anything on the property that meets these criteria, which I'll talk about one at a time. So the first part is that the component in question must be that association's responsibility, which I think is pretty straightforward, but an example of something that might fail this part of the test would be windows and doors in a condo building. In our experience, at least 99% of the time, the individual unit owners are responsible for replacement of their own windows and doors. So in those cases, there's no need to include them in the association's funding plan, right? In the case of an HOA where you've got roads that are public, they're maintained by the city or by the county, then there's no need to include funding for road repaving. Okay. Now, this is another example where I think the Senate Bill 4D, despite good intentions, got some of the details wrong. One of the things they put on the structural integrity reserve study list is windows, and it didn't qualify to say common area windows or common element windows. And that's been a lot of confusion in the industry. You know, do we need to fund for windows? And I would say that this is something that hopefully is going to be addressed in this cleanup bill, that it will specify only common elements or association property are what we're talking about. All right, the second part of this test is that the component has to have a limited useful life. So in our industry, we typically don't use the word forever, but if something should last indefinitely and there's no timeline where you would expect to replace it, then I would argue it shouldn't be considered in your funding plan. So as an example, you know, I would always say something like the foundation of a building, the load-bearing walls, the electrical conduit inside those walls. Those are things that should last the life of the property, however long that may be, and therefore you should not be actively funding for their replacement. You know, if your foundation is going bad, if it can't be repaired, then guess what? You're probably going to have a developer come in and knock the building down, build something new, before you would ever actually replace that. So again, another point where we're kind of deviating from the structural integrity reserve study checklist here. Now, the third part of the test is, I think, the most complicated, which is that a component has to have a predictable remaining useful life in order for it to be appropriate to include that in a reserve schedule, a reserve funding plan. Now, the key word here is predictable. And to be more specific, what I mean is predictability in terms of scope and frequency. So if you can't reliably predict how much money you'll spend on something or how often, then it's probably not a good idea to address that through reserves. Let me give you an example. Many associations will ask whether they can include their insurance deductible as part of their reserve plan. Their argument being, look, this is a really big number, and if we have to pay that one day, we want to have some money set aside for it. And I say, great idea, but here's the problem. If you want to treat this as a reserve component, we have to assign it a useful life, right? In other words, how often do you pay that deductible, which of course nobody knows. That's the whole reason you have insurance in the first place. These expenses come as a surprise. They're a result of a natural disaster, a hurricane, a fire, a flood. And to make some arbitrary prediction about how often those types of things would occur really is getting away from the whole point of responsible planning. Now, this is an important point. That's not to say that we don't recommend you have some kind of plan in place, right? It's Florida. There will always be more hurricanes coming over the years. The problem is that we just don't know how often or how severe those will be. And so there's really no way for us to responsibly, accurately tell a client how often they'll be paying that insurance deductible, right? So in this case, and this happens all the time, what I'll tell them is, look, you should probably have some kind of third account for your association. You have your operating account for your routine expenses. You have your reserve account for all the components that do meet these criteria. In addition to those, maybe it's a good idea to establish some kind of emergency fund, right? Or even an emergency line of credit that would be available to your community in the event you have to pay your insurance deductible. The problem, again, the problem with listing it as a reserve component is that we're ultimately going to be basing some funding calculations off of a timeline of expenses. And if those expenses don't fall in line with the plan in reality, then all those calculations go out the window, right? Let's just make a guess. Let's say we assumed a useful life of 10 years for paying an insurance deductible for windstorm. But what happens if that doesn't turn out to be true, right? We're making a wild guess that we'll get that major hurricane once every 10 years. But what if you get 3 storms in a period of 5 years, right? Like our unlucky friends on the Gulf Coast these last couple of years. And you're expecting that your reserve account is going to pay for that deductible each time, right? What happens in that case, if you're going to do it that way, is you're actually much more likely to pull money away from other reserve components that do have a predictable lifespan, which will probably end up resulting in special assessments to make up for the shortfalls when those projects come due. All right, I know there's a long slide, a lot of content here, but I'm going to get to the end here in a second. The last criteria on this 4-part test is, does this component represent a significant cost to the association? Now, I showed earlier the statutory number of $10,000, but again, I think that's kind of arbitrary. In our experience, for most associations, we would recommend setting that threshold a lot lower. Now, why would we do that? Well, the advantage of doing it that way is that you will have more components captured in your reserve schedule, which takes the pressure off of the operating budget, which is otherwise going to be the only place to absorb those costs when they come along, right? So let's do an example. Let's just imagine there's a small association out there, and they have 6 projects on their schedule that cost $5,000 each. Now, technically speaking, they would be compliant with the statutes if they left those out of their reserve plan, because individually they cost less than that $10,000 number. But however, let's say that all 6 projects happen to occur around the same time. In total, that's a total amount of spending of $30,000 that they would then have to squeeze into the operating budget in that year. Now, if cash flow is a little tight and they, maybe have some bad debt, maybe all of a sudden they find themselves in a tough situation. Had they listed those in their reserve plan, though, they would then have the ability to spend reserve money on those things, which hopefully is less disruptive to the association. They would be tracking those, they'd be forecasting, putting money away, and when they came along, no big deal, right? So the point is, just in conclusion here, there is no one number that I think is appropriate for any and all associations. I think every association out there needs to consider what is financially significant for us and then plan from there. Okay, outcome number 2. Again, we're talking about what do you get from a reserve study? And this one is what we call the evaluation of current reserve fund strength. We often describe this using a term called percent funded. So one of the best ways that I found to explain percent funded is to use the analogy of a credit score. Okay, now we've all as individuals had our credit reports pulled. You probably know roughly what your credit score is. And you understand that to an outside party like a bank or a credit card company, your credit score is an indicator of what kind of risk you are. So in the same way, if you think of the reserve study itself like a credit report, and you have to distill it down to one key result, I would argue that should be percent funded. And we measure this on a 0 to 100% scale, and we consider anything between 0 and 30% funded to be a weak position. In that range, those associations will have a much higher likelihood of special assessments and other cash flow problems. Once you get above 30% funded, we call that a fair range. The risk is a lot more moderate here, right? It's not an emergency anymore, but things could probably be better. Where you really want to be is above 70% funded. That's where we see the lowest statistical risk of those types of financial problems occurring. Okay, we've talked about percent funded conceptually, right? That's my kind of analogy to the credit score. Now I'm going to walk you through how do we actually calculate it. And it's a fairly simple idea. All we're really doing here is we're looking at how much money an association has at some point in time, and then comparing that amount against how much money it should have, ideally, at the same point in time. We're just going to express that comparison as a percentage, and that's their percent funded. Okay, so the first part, how much money do they have? This is the easy part, right? So when we're doing a reserve study for our client, we're going to look at their current financial statements, maybe get in touch with their bookkeeper, their accountant, and try to project forward to the start of the next fiscal year. So even though we're just right now in March, the studies we're doing now are looking ahead typically to January 1st, 2024. And we want to estimate how much money will be in reserves at that point in time. The second part is to determine how much money that they should have. Now, this notion, this concept of how much they should have, that is represented by an amount that we call the fully funded balance. So just to make this clear, the fully funded balance is a theoretical number. And the way that I always put this in perspective is to pose it as a question. If I told you that there's an association out there that has $50,000 in reserves, but I have not told you anything else about the community, right? You don't know where it's located, how many units there are, how old it is, how many amenities they've got. Is that meaningful information at all, right? And I would say it's not, but we hear the sort of thing all the time from our clients. Somebody might say at the start of a project, look, I think we're in great shape. We have $900,000 in reserves. And I'll say, okay, that's good. Well, I'm glad to hear you have some money set aside, but I don't have any idea if that's adequate unless we know what to compare it against, right? And this, of course, depends on what type of property we're talking about. If you've got a little 2-story building, no amenities, just a little parking lot, it could be that $50,000 is plenty of money for that property. But if we're dealing with a big luxury high-rise condo, right, you understand $50,000 is a drop in the bucket. That can be wiped out in one installment of one painting project, for example. All right, so we'll take this one step further now. I'm going to show you how do we calculate that denominator, that fully funded balance. Now, again, a fairly simple idea. We're going to look at how old any given component is compared to its overall lifespan, right? The age divided by the useful life. That will give us a fraction. I'm then going to multiply this fraction by the replacement cost estimate for that component. That will tell me how much money that association should have in the bank today for its eventual replacement. Now, it doesn't matter if you've got 4 components or 400, this is the approach that we take. We're going to calculate the fully funded balance for each item, then add all those numbers together. That will tell us the fully funded balance for the entire association. Once we've done that, then we can go back and look at their actual cash on hand, put that number in perspective, and make a determination of percent funded. All right, so we'll do a quick example just to bring this home. Let's all pretend that we're on the board of this community. We'll call it the CEU condominiums. And let's say our task is to calculate percent funded for this association going into the next fiscal year. All right, so pardon the typo there. Let's imagine that says 2024, because again, a reserve study is always a forward-looking document. But again, you understand the first thing to do here is to establish the starting reserve balance for this fiscal year. Let's say we've done that. We looked at our financial statements. We've modeled in the remaining spending from reserves this year. We know how much is budgeted to be contributed to reserves this year. Let's say we do that math and we end up at a starting position of $60,000. Okay. The next thing we're going to do is to calculate the fully funded balance for each component of this property. And for the sake of this example, I'm going to limit it to just 3 things. We'll first look at the roof. Let's say that the roof on this building is 10 years old with an overall useful life of 20 years. And let's say it's got an estimated replacement cost of 80 grand. Okay. Now, again, keep in mind that the fully funded balance is the proportion of this cost that they should have on hand today. So since it is halfway through its life, right, they only need to have half of the replacement cost in the bank right now because they have another 10 years to collect the difference. So in this case, we would take 10 over 20, 1/2, multiply that by $80,000, which tells us that the theoretical fully funded balance for this roof right now is only $40,000. It's halfway through its life, so they should have half of the cost in the bank. Okay, let's look at our next example. Let's say we're going to do this for the gym equipment. Now, if the equipment is currently 5 years old with an overall life expectancy of 15 years and a replacement cost of 30 grand, we can figure out that the fully funded balance for this gym equipment right now is $10,000, right? It's a third of the way through its life. They should have a third of the replacement cost saved up. Okay, last example. Let's say that we painted the hallways of this building 2 years ago, and it's going to be done every 8 years, right? The age is 2 years, 8 years is the useful life. Let's say the cost was $100,000. Okay, 2 divided by 8 times 100,000 means that the fully funded balance for hallway painting at this point in time is 25 grand. Okay, so now that we have estimated our starting reserve balance, right, the $60,000, and we have calculated the individual fully funded balances for those 3 components, now we can calculate percent funded for the entire community. Right? We take the 3 numbers that we calculated, add them together, 40 grand for the roof, 10,000 for our gym equipment, 25 for painting. That's 75,000 in total. That's our fully funded balance for this community. Now I'm going to look at that 60,000 that they do have, take 60 divided by 75, they're 80% funded, right? So the takeaway here would be this community is really in pretty good shape. They're fairly close to what they should have, little room for improvement, and going forward, they might need to contribute a little bit more to reserves to stay out of trouble. But overall, this would be a pretty good outcome. All right, our third and final outcome that you get from a reserve study is the funding plan. Now, if you think about the first 2 that we covered, we talked about the component list, which basically is just defining what you're reserving for in the first place. I then talked about percent funded. That tells us where the community stands financially as of this point in time. But once you know those 2 things, the last question to answer is, where do you go from here? And this is where we start designing a funding plan. The point is to, or I guess the first step is to look at the current budget and just try to run that out over time. What would happen if this association just continued funding reserves the way they were? What happens given those future expenses that we can put on our timeline? Will they have enough money or not? Now, if it's clear that when we model that out, that their current reserve budget is not going to be sufficient, then we'll have to recommend some changes. Okay, 2 of the other points to make here are that well, first of all, the funding of reserves needs to be consistent with the timing of your overall assessments. So for example, if you have monthly dues that are payable to your association, there needs to be a monthly reserve contribution. I believe by law in Florida that has to be made within 30 days. In other words, what I'm saying is that you cannot just operate throughout the year, hoping that at the end of the year, you'll have some kind of surplus money set aside. You can transfer that into reserves one time on December 31st and say, hey, look, we funded reserves this year. It's not supposed to work that way. Okay, this needs to be a proactive, ongoing plan. All right, the last point to make here on this slide is that in these cases where historically the contribution rate has not been sufficient, right? If the association is in pretty bad shape financially, unfortunately, there might need to be an initial special assessment that is part of that funding plan. Now, I've been making this point recently over and over again. I don't think there's anything special about special assessments. Usually it's just the inevitable result of many years of insufficient funding. It should not come as a surprise if your association is waiving reserves or partially funding, especially doing that for many years. If when you get a reserve study, they point out, look, you've got a bunch of projects that need to happen in the very near future, and you have run out of time to collect money for those things in your normal budgeting. That's what a special assessment is. Of course, there's cases where there are truly surprises, but the majority of the special assessments I see are there because that association did not contribute money over the course of their prior years. Okay, a couple of important principles here. In the interest of time, I'm not going to spend too much time on these, except for the fourth one, which I do want to get into a little bit more detail. But generally speaking, when you're designing a reserve funding plan, first and foremost, you want to make sure that that funding plan will always have sufficient cash on hand for the association. At minimum, that means you never run out of money. You never go below zero. There is a methodology in reserve funding, which is called baseline funding, which means you are putting aside just barely enough to stay above zero. I teach a whole nother class on that subject, and maybe we'll have that for you guys sometime later this spring or summer. It's called reserve funding methodologies. But at minimum, any reserve funding plan cannot have some future year where you run out, because all that means is that you will need a special assessment at that point in time, which you cannot count on. Reserve funding is distributed amongst all of your components. Okay, that means you're funding everything all the time. You don't take years off. So even if you might have just modernized your elevators, that's not a once in a lifetime thing. That will need to be done again in the future. So all that happens is that the clock starts over. You start funding again for the next time, basically as soon as you've finished the most recent project. You want your contributions to be stable, right? Sometimes that means you can have a small increase from year to year, but you should not have wild fluctuations in your reserve contributions each year. I've seen some funding plans that were sent to me where people kind of crafted these plans that track the spending in each year, where they say, okay, if we have $30,000 to spend next year, we'll fund $30,000 in reserves. But if we have 80,000 5 years from now, then we'll put 80,000 into that year's budget. That's not the way it's supposed to work. Your expenses are always going to be volatile. They will always fluctuate, but the contributions to meet those expenses should be more stable. They should be offsetting that variability. Okay, the last point here I'm going to spend a little bit more time on, which is to be fiscally responsible. Now, what does that mean? First and foremost, we think it means being realistic with respect to interest and inflation. Okay, it is just not realistic to assume that you're going to get 10% interest each year on your reserve funds. We just know that reserve money can't be invested in anything very exciting, unfortunately, right? So that means you should be assuming a fairly low return on those funds. If you're modeling cash flow that is very interest dependent, that's not realistic with respect to community associations. Talking about inflation, always have to be realistic there too. What we have found is that through historical data trends, over a long enough period of time, the average annual inflation rate tends to hover right around 3%. Now, if you're assuming that the cost of a project 15 years from now will be the same as what it costs today, or vice versa, you're assuming that your current cost estimate is what you paid 15 years ago, that's going to be way off, right? That plan will just not work. So always be making sure that you're using current cost estimates, using a responsible number for inflation going forward. Okay, the second point on the slide means let's be honest about the situation that we're in, right? Like I mentioned a moment ago, if the association has not historically done a good job of funding reserves, it's time to put a stop to that, right? You have to tell it like it is. It is just financially irresponsible to continue operating the way you always have, just to try and maintain some kind of status quo, right? It is not the job of the board of directors to make the owners happy. It is not their job to keep the dues low compared to the building next door, right? It is not the job of the board to cater to the financial capability of the least well-off person in the building, right? This is going to be an uncomfortable conversation that a lot of buildings are going to have in these next few years. If you've got people on fixed income who cannot afford any increases in their dues, the sad reality is that some of those people may need to find a new place to live. It's not fair to everybody else in the condo to pick up the burden for those people who cannot afford the cost of ownership. Okay, speaking of owners, the reserve funding plan cannot be biased in favor of the people who live there now at the expense of the people who will live there later on, right? You can't just assume that 10, 20 years from now, some group of owners are going to come along and pay the tab for your waiving of reserves that you've done all this time. Now, lastly, this all takes place despite the past. Whatever has been done in the past has been done. And if you've been waiving reserves, partially funding, there's nothing you can really do about that, right? The can has been kicked to you. That is not an excuse to go ahead and kick that can down the road for the next group, right? In a perfect world, of course, all associations would have been given good advice. They would have followed it. They would have plenty of money in the bank. But we know in reality, that's usually not the case. That does not in any way remove the obligation from the board of directors to act responsibly and to fulfill their fiduciary duty. Okay, so we've got about 15 minutes or so here before the Q&A. I'm going to try to anticipate what some of these questions might be, but I just wanted to give everybody a brief kind of summary and overview of Senate Bill 4D. This is a piece of legislation that passed last May in a special session. If you go back even further in the regular session of Congress in Florida, or of the Florida government, back in March of last year, there were two bills on the table that were both effectively a legislative response to the tragedy at Champlain Tower South, right? The tower collapse that killed 98 people that we're all familiar with. It's just the worst thing that's ever happened in the community association world by far. And what the legislators were tasked with doing in response to that was very complicated, right? You're dealing with thousands and thousands of buildings. I believe it's about a half of Florida citizens live in condo associations of one type or another. So this is not a fringe issue, but they were tasked with an unprecedented building collapse and a monumental challenge of how do we prevent that from happening again. So they passed this bill, I should say in the regular session. Again, there was a House bill and a Senate bill that both had a bunch of good ideas in them, but nothing ended up going before the governor in the regular session. Kind of ended in a stalemate. They could not agree with each other on some of the key provisions. So what happened next was in May of last year, Governor DeSantis called a special session, which was originally going to be just covering the insurance crisis in the state, which we could fill a whole nother hour talking about that. But in the course of that session, they said, look, we didn't do this in the regular session. We've got to get something done. So they hammered out Senate Bill 4D in a very quick amount of time with very little insight or oversight or input from the industry. But what I'm going to do now is attempt to just kind of highlight some of the key ideas in the bill, the pros and cons, and then we'll talk about maybe where we go from here. So generally speaking, I think the spirit of this legislation was good. I know it was well intentioned. I've met with some of the people who helped to write it. Their hearts are in the right place, but they don't do this stuff on a daily basis. So they got some important things, a little bit wrong. But let me talk about what I think they got right. First and foremost, this bill will make documents related to condo associations more available, more transparent, easier to find for residents, for potential buyers. And that's a good thing. I think we should operate in the sunshine. I think people who are going to buy into a condo deserve to know as much as they can about the physical and financial state of that association. I think one of the saddest parts of the Champlain Tower South tragedy is that just in the couple of months leading up to the collapse, there was, I think, more than 10 or 12 units that had been bought and sold in the building. Now I have to know, and it makes the hair on the back of my neck stand up, what did those people know when they closed on those units, right? Were they aware of the, looming, financial clouds that they had there? Were they aware of the known physical problems in the building? We don't know. But this bill seeks to improve upon that. It's going to make things easier to find. Things will be on file with public records and things like that. So that's a good thing. The next part are milestone inspections. So for those of you who are in Dade and Broward County, you're probably familiar with the 40-year certification requirement, which has been in place for decades. Basically means that when a building turns 40 years old, they have an architect or an engineer come out and inspect the property to ensure that it is safe and that there's no major problems that need to be addressed, specifically with the structure and the electrical and maybe life safety components. Every 10 years after that, they would have to have that renewed, and it's just an ongoing thing over the life of that building. So these milestone inspections, to me, are very much an extension of that program, but applied across the state. So now all 67 counties in Florida will have a milestone inspection requirement. The timeline for having those done is also accelerated. So if your property is within 3 miles of the coastline, your first milestone inspection will be due at 25 years, and then every 10 years after that. If you are more than 3 miles from the coastline, your first inspection is at 30 years, and then every 10 after that. So that's a good thing. That means that buildings, as they age, are going to be looked at by people who can address structural concerns, who can highlight problems that need to be fixed before they become worse. That's a good thing. You know, I know that Champlain Towers South, I believe, had done their 40-year certification, but let's say it had been done at 25 years. Maybe there's some idea that, you know, problems could have been identified before they became worse. I don't know that to be true, but maybe there was some hope there. So that's a new requirement. You know, if you've got a good relationship with an engineering company, I'm sure they're already very well familiar with this. If you don't, you're going to want to get in line to do this if your building meets those criteria. I should also step back for a second. This bill only applies to condos and co-ops. So for those of you representing HOAs, I think this is probably still helpful information for you, but this does not apply to HOAs. At this point, it also does not apply to condos and co-ops less than 3 stories. So if you're 3 stories and up, this is where you guys all need to be paying attention. The third part of this bill institutes a new requirement, something called a structural integrity reserve study, which I'll talk a little bit more about on my next slide, but suffice to say that that was well-intentioned but poorly executed. The last part of this I think is very good, but it's going to be painful, right? Mandatory reserve funding. Beginning after December 31st, 2024, associations, condos, and co-ops will not be allowed to waive reserve funding or to partially fund for their major components. I don't think there's any reason why that's a bad thing, right? Florida is the only state in the country that up until now, the membership of an association has been allowed to vote to waive reserve funding. And the state is basically closing that loophole, preventing associations from digging themselves into these financial holes that are very, very difficult to climb out of. So that there's more good than bad in this bill. But some of the bad parts, I think, focused around this structural integrity reserve study issue. First of all, there is no such thing, right? The term structural integrity reserve study did not exist until the end of May of last year, right? There are reserve studies, which, you know, I've just given you an hour-long class on what those are. There are structural evaluations that can be done by engineers. There's property condition assessments, right? There are ways of you know, identifying the structural integrity of a property, but it's never been kind of Frankenstein together with a reserve study in this fashion. Personally, I think some of the inspection requirements are a little redundant with the milestone inspections. You know, right now the CERS, as we're calling it, would require that you have an engineer conduct your visual inspection of the property. But what if you've just had an engineer out to do your milestone inspection? Does that meet the same criteria? What if it was 18 months ago or 3 years ago? There's not a lot of clarity there about whether, if you've had a 40-year certification done, does that meet your visual inspection requirement? Another thing I mentioned earlier, the frequency, right? So the structural integrity reserve study would be done earlier in the building's life. It's within the first 10 years of the certificate of occupancy, and then every 10 years after that. So this is not waiting until buildings get older. They have, even newer buildings would have to do this, but I would argue that every 10 years is not often enough, right? If we just looked at a reserve study from 10 years ago and compared it to how we would price things out today and all the life expectancies we would use today, that's going to be wildly different. So I would say that this is something that needs to be done earlier, but also more often than other types of services. The scope of work, you know, much has been made about the things that they put on the checklist for structural integrity reserve study requirements. Kind of alluded to a couple of those earlier, and many people have kind of scratched their heads about foundations. You know, why should we include funding for replacing or repairing our foundation when it shouldn't have a limited lifespan? It should be there indefinitely. Other details in there, like I mentioned, the windows, but also, load-bearing walls and primary structural members. These are literally the bones of the building that hold it up. Typically not things you would budget to be replacing. Now, obviously, allowances for concrete restoration, for balcony decks and catwalks and planters and plaza decks, absolutely, those should be factored in. But categorically saying load-bearing walls in a building is I think an overreach. There's more to it, plumbing, electrical, those are things that are situationally seen as reserve components, but not always. But I think what most people have kind of alerted to really quickly is that the volume of work and the availability of the people who would do these is going to make this effectively impossible. Okay, there's about 25,000 condos and co-ops that would have to have a structural integrity reserve study done by the end of December 2024. Okay, so that's less than 2 years from now. If you combined all of the reserve study providers and all the engineers in Florida together and they did nothing but this 24/7, I still don't think that's anywhere close to enough time to get this work done. So we're going to see what happens. Obviously, there's more to be said about this. And good news is that we do have a new Senate bill, Senate Bill 154, which was filed and has passed it through at least one committee of the Senate that I'm aware of. That's going to go into discussion here just in the next week. I think it's on Tuesday is when the next legislative session begins. And this Senate Bill 154 is going to be a very, very hot topic this spring. We'll see if the House of Representatives has any major changes to that, if they approve it, if they have their own bill. We just don't know that yet, but we're going to know a lot more in the next 30 to 60 days. So if you've been waiting to see what happens before acting on these structural integrity reserve study requirements, I don't blame you. But I would say that, we're going to have some clearer answers soon and hopefully a lot more practical way of moving forward. So what should you do now? I've got a couple ideas. First of all, if you don't have a milestone inspection done, if you've never done a 40-year inspection, you're outside of Dade and Broward, find a good local engineering firm, ideally I would say probably a structural engineer, and talk to them about their requirements. I've talked to dozens of these folks in the last 6 or 8 months, and they have a line out the door. But there's good reason for that. There's a lot of older properties in Florida that need a lot of work done. So I would say that getting a good team together now is a great idea. In the meantime, we're still doing, and others are doing, traditional reserve studies, which I think actually go above and beyond the structural integrity requirements in some ways, without overburdening communities with funding for things that shouldn't need to be replaced. So obviously we'll know more in the near future about what these new requirements might be. If the law becomes just to have a reserve study done without the structural integrity wording, I think that makes things a lot clearer. Last but maybe not least, and maybe most important for some of you out there, I think there needs to be a lot of communication between board members and their members that the cost of condo living will be increasing. Forget everything I've just said in the last hour. If nothing else, the cost of insurance is probably not going to go down anytime soon. Look at the overall economy. We're in a state of inflation. Things like payroll and utilities are not going to go down anytime soon. This is going to be harmful. This is going to be painful for a lot of members out there who live in these associations. I've talked to lots of buildings already that are saying, do we dissolve our condo? Do we sell our building to a developer? And those are going to be real questions that need to be answered in the near future. But what I will say is that I think the associations that are doing a good job financially, that have been funding reserves, they are going to be in a very nice position. They will be more attractive to buyers looking to move into Florida, more attractive to lenders who are going to be writing mortgages on those properties. This is a major shakeup for our industry, but I think at the end of the day, the net, positives are going to be good. So that is just about an hour. I'm going to take a swig of water here, and then Ashley, I don't know if you're going to join us for the Q&A, just kind of walk us through that. But if you want to get things started.
Yep, I'm here. I am going to go ahead and launch the poll, just in case anybody has to jump off and they don't want to stay for the Q&A. We'd really appreciate you taking that for us. I did just launch it. Also, again, because I did see it in the chat, or in the Q&A, I did see a few of the housekeeping items I addressed. So I will be sending this presentation out via email after, along with the recording of this webinar, and you can feel free to share it with other board members. But that will be sent out after. I will also be giving the attendee list to Will, and he will go ahead and get the credits issued for that. And then, yeah, we have the Q&A. I don't know how you want to handle it, Will. Do you want me to read them to you, go through them? Do you want to just go ahead and answer some? However you want to handle it.
Well, I think so. Here's what I'm thinking is I'll start at the top with kind of the oldest ones in the queue,
Okay.
and I'll try to do my best to answer those. If you want to kind of comb through the rest right now, just so everybody knows, I have 39 open questions. I don't know that we're going to get through all those in 20 or 30 minutes, but we'll try. A couple just kind of caveats. I'm not an attorney, so if any of these questions are legal in nature, if they're asking for interpretation of governing documents or statutes or anything like that, I'm not the guy for that. Consult your association's counsel. I've also not seen any of these questions ahead of time, so if I kind of stumble my way through them, I apologize, but some of these questions sometimes are a little bit tricky to interpret what the person's asking. I do have my email address there up on the screen. So, take that down if anybody has questions. If you wanted to get any more information about our company, again, reservestudy.com. But let me try to go through the list here. So first question, interested in what will be required of two-story structures. From what I've heard, they will be exempt from the milestone inspections and the structural integrity reserve study requirements. But I think that assuming they're still condos or co-ops, will still be required to mandatorily fund reserves. So again, there's, I guess, a little bit of gray area there. If that waiver of reserve funding still applies to two-story or one-story properties, honestly, I would act as if you're going to be subject to the same financial requirements. Every association out there should be fully funding its reserves or having, I guess the capability to pass special assessments is definitely going to be in your future. So but the physical requirements for milestone and the CERS reports, so far I've not heard anything about two-story buildings there. Can you borrow against a reserve fund? That's a good question. I believe that you can. We've certainly have had associations borrow money from their reserves to cover a shortfall in operating, for example. Not always a great idea. Again, I would say that should be your kind of last resort, because reserve money was there for intended purposes. If you're pulling money out, at the very least, you should have a plan to put it back within the very near future. Okay, what is the optimal time to schedule the structural integrity reserve study? I know, and I could speak for our company, but also for some others that I've been in touch with, we're still kind of waiting to see what these new requirements are going to be. I would say within the next 30 to 60 days, we should have a clearer answer. But by all means, you can start to gather information. You can get proposals for that now. And our industry will be responding to the new requirements as best we can in the near future. But yeah, there's just the volume of properties that are going to need to have this done. I would say there's really no time to wait. Okay, yeah, so some of these questions I think that I've addressed in the course of the presentation. People just asked them early on, so I might skip over some of them, but let me see if I can shed some light on these. So with the mandatory CERS, does it have to have all of the elements of the milestone inspection, even if items such as windows, which are not the responsibility of the association, but of the unit owners? So that's a nice feature of the cleanup bill. The Senate Bill 154 includes some new language that says, can't remember the exact wording, but it basically is limited to association property as defined by the declaration. So if your declaration makes it clear that the maintenance responsibility for certain things is the owner, then those would not need to be included in your funding. Okay, our HOA attorney advised the following: the new Florida condo reserve law specifically applies to 3-story condos and above. Do you agree? Yes. Well, I would say with respect to the milestone and structural integrity requirements, again, that's 3 stories and up. The funding of reserves, I think you could argue, is for all condo associations. Okay, on average, how often should an HOA consisting of 72 townhomes perform a reserve study? Best practice is every 3 years to have an on-site inspection done, especially in Florida, and especially if you're near the coast. Just the coastal, deterioration of components means that life expectancies change pretty quickly. It's kind of like going to the doctor, right? If you go to the doctor fairly regularly, you're going to catch problems before they become worse. If you wait 10 years between checkups, you can develop some kind of condition or ailment that, had you gone to see the doctor earlier, maybe it would have been easier to treat. So, early and often, 3 years is a good rule of thumb. Yeah, shouldn't you have at least 10 to 20% left in your operating each year rather than ending December 31st at 0? Yes, I agree with that. But presuming that you have rolled that over from last year, right? If you have 100 grand sitting in your operating account on January 1st, and you want to keep 100 grand left in your operating account at the end of that year, that's a good thing. You should always have a little cushion there. I don't mean to run it down to 0. What I mean is that provided you're sitting on that cushion, every dollar that you accumulate should most likely be spent within the same year. So, whatever your accountant advises, sometimes that's 2 months of operating expenses, 3 months, maybe if you're real conservative, 6 months of operating expenses. Yeah, you want to have a cushion left there, but the point about operating money is that it really shouldn't carry over and accumulate and start building up a balance there. Is there a difference between commercial and residential reserve components, specifically painting? I'm not sure if I understand the question, but I think I would probably say no. I mean, if it's the association's responsibility to pay for something, then it should be in their funding plan. If you have a commercial association on your property and a residential, or if the association paints, some elements, but owners paint the other elements, that's how I would view it. Otherwise, I'm not sure if I'm reading that question correctly. I apologize. Let's see. Definition of deferred maintenance. Okay, so that's an interesting question. That's something that, I've actually heard different definitions. To me, the kind of nefarious definition is, just delaying and deferring a project in the hopes of saving money on it, right? Not painting a fence because you don't want to pay for it, but year after year, the deterioration, the exposure of that fence is just going to make it worse and worse. That's deferred maintenance. You should have been doing it proactively. You've deferred it. Maybe there's different accounting definitions of it, but I think from our standpoint, our perspective, it means that kicking the can down the road, trying to save a buck and not doing work that you should be doing. And usually the result of that is that it becomes more expensive over time. Okay, let's see. Why would you not want to decide in 1 year that you want to do a capital improvement in the future and pay for it by putting money in reserve for, say, 5 years when you can pay for the item rather than taking out a loan? Perhaps that would not be considered a reserve. That's a good question. Yeah, so I totally agree with the logic there. I would not call it a reserve account. Just call it a special projects fund or something like that. If you said, look, 5 years from now, we want to build that playground, and it's going to cost us, $100,000, and we want to put aside 20 grand a year in the next 5 years in our special projects fund, by all means, go ahead and do that. The issue is that when you call something a reserve account, that's when these legal and statutory restrictions come into play. So if you've got capital improvements you want to pay for using that kind of format, totally good with that. Let's see, are reserves required for HOAs with an expected expense such as resurfacing private roads? Well, I would say the physical reality of the project is that you will have to pay for that one day. So I would say from a practical standpoint, reserves are required. The only other options would be a special assessment or a loan when that project eventually comes due. We can get into a little bit more detail down a rabbit hole of HOAs having either statutory or non-statutory reserves. If you have statutory reserves, that means they were either created by the developer or established by a voting interest of the owners at some point. In those cases, then you do have to have reserves in the budget, and it starts to function more like a condo. If neither of those two conditions exist and you just have a voluntary reserve fund or savings fund for maintaining the property, that's more at the board's discretion. But I would say in either case, if you know you're going to have to spend money on something, start saving for it as early as you can. Let's see, what is the current lead time to have a reserve study completed from signing agreement till completed? Again, I can only speak for our company, but I'm sure others are probably in a similar boat right now. There's a couple factors. One is location, right? If you're nearby our office, we can probably get you pretty soon. But even now, I would say we're booking inspections out at least a month, sometimes 6 weeks, 8 weeks from signing the agreement. And then typically, I think most providers will need at least 6 to 8 weeks from doing that inspection to actually delivering the study. If you've had one done before and you're just looking for an update, that should be a little quicker process. But otherwise, yeah, figure from start to finish, from signing the agreement to having that document in hand, 2, 3, 4 months, maybe, depending on some factors, where the property is located and so forth. Okay, I want to know if we can use reserves to fix leaking planters from a deck on top of a garage. Water is coming inside the garage and there is some residue of calcium on the facade of the property. Put aside how you're going to pay for it. You need to get that fixed. That is a severe waterproofing issue. Every time we see planters on a pool deck or a plaza deck on top of a garage, you want to think of those as concrete bathtubs, right? And usually if there was waterproofing applied in those when they were built, sometimes it's failed, maybe 15, 20 years is about the lifespan for the waterproofing. You need to get that fixed. Now, whether or not you can use reserves for it, that's kind of an individual scenario. If you've got a reserve component on your schedule that addresses the planters, absolutely. If you have something like, plaza deck waterproofing or painting and waterproofing, maybe you can justify that. If you don't have that in your reserves, you definitely need to add that going forward. There's just no question about it. That is a major issue that can develop into a structural problem. So anytime, just as a rule of thumb, anytime water gets into a building where it's not supposed to be, that's an immediate urgent concern, bar none. Okay, are legal fees always operating expenses, or can they be reserve fees? Example, contract review or a lawsuit involving a reserve component contractor. That's a good question. I would say they probably should be operating expenses. In certain cases, if you can really tie it into the scope of a reserve project, like you've got 3 bids for modernizing elevators and you want to have your attorney look over those bids before you choose one. To me, that's kind of part and parcel with doing the job. So I would say that's an easier one. Suing a contractor for work that's already done and charging that to reserves, I think that's a little more slippery. Again, better question for your attorney, but I would say usually that should be in the operating budget. Let's see, a similar question here. Is the cost of professional fees put on the reserve schedule? I would say it can be. So if you are doing, a best example here would be concrete restoration, right? Every 7 to 10 years, buildings need to be painted. And I would say during each paint cycle, you should have a civil or a structural engineer come and inspect the facade and the building to find out, do we need to do any concrete work? Do we want to have this engineer serve as a project manager to oversee the painting contractor? To me, that's money well spent. And I would say that when you look at your total reserve schedule, you should factor in the professional fees that are related to getting the work done. So I would say, yes, if it's engineering fees or, consultants fees for an elevator project or a paving project, you can lump that in with the total cost of getting that work done because they're part of the team that is executing that work. So I would say yes in those cases. Another example, see it sometimes, interior design fees. If you're going to remodel your lobby and you're going to pay tens of thousands of dollars to an interior designer, but it's in the scope of doing the bigger project, I would say yes, that to me, that fits a reserve definition. Let's see. How does a reserve study calculate the cost of a roof replacement 20 years in the future? Well, you always start with the current cost. If we had to do this project now, what would that cost? And from there, you just apply whatever assumption for inflation you want to use. So if you're assuming it's going to go up by 3% each year, it's a pretty simple formula just to model that growth increase over 20 years and figure out what the future cost of that roof might be. So just a real quick back of the envelope math for you guys out there. there's a rule in finance and accounting called the rule of 72. And if you take the number 72 and you divide by an interest rate or a growth rate, that will tell you how long it takes something to double. So if we take 72 and divide by 3, just assuming 3% interest, or excuse me, 3% inflation, that means that a cost today would double after 24 years, 3 times 24. So if you're looking at a roof project that's, current cost is X, 20 years from now, it will have close to doubled if you assume 3% inflation. Okay. During this study, is an audit performed? I'm guessing you mean like an accounting audit, and I would say no, that's a totally separate thing. Associations also do need to be having their books audited by an accounting professional, I believe every year. Depends on, I think, the size of the budget, maybe. Those rules have changed a little bit, but this is totally separate. A financial audit encompasses all of the financial workings of an association, operating reserves, maybe even insurance. But the reserve study is focused just on the reserve portion of that budget. Would elevators, electrical, and mechanical systems be included in a funded reserve? Absolutely. Yeah. If they meet that 4-part test, if they're the association's responsibility with limited life expectancies, predictable remaining life, and meeting a significant threshold cost, those need to be in your reserves, just bar none. Doesn't matter what your declaration says. It doesn't really matter what the statutes say. If they meet those criteria, you should be funding those as reserve components. All right, can the CERS study be using the cash flow reserve method? Yes. This has been something that, again, I don't think was made very clear in the Senate Bill 4D, but the Florida DBPR has since published an FAQ page on their website. One of the questions they put up there is, can you still use the pooled method, the cash flow method, for doing a reserve study? And they said yes. It's a little bit tricky how to interpret that, because what they're now kind of proposing is that there would almost be 2 pools of funds, one for the structural integrity criteria list, one for everything else. That first group can be waived, or excuse me, cannot be waived or partially funded. Maybe the second group with other things can. But yes, you can still use the cash flow or the pooled method for doing that. Okay, to use funds in reserves for the other items, does there need to be a vote of the unit owners, or is the board vote sufficient? No, it's typically a membership vote. Sometimes it can be a majority of a quorum. So it depends. It's maybe subject to something in your declaration, but it is usually not just a board vote that needs to take place there. It's considered a non-statutory use of reserve funds anytime you're using them for other than their intended purpose, and that usually needs to be approved by the membership. Okay, what financial account can we keep the money? Yields are good now. Yes, yeah, interest rates are coming up a little bit, which is great, but still the vehicles for investing reserves are pretty limited. Typically going to be CDs, money market funds, maybe T-bills. The rule of thumb typically is that you can't you can't put the principal at risk. That the board could be seen to be in breach of their fiduciary duty if they lose money on investments, right? So, the good news is that even those very safe, very conservative funds now are at least delivering a little bit higher percentage. But yeah, you can't go buy a bunch of Bitcoin with your reserve funds, unfortunately. All right, does the interest earned on reserves have to be used for reserves? I believe that is true. Yeah, I would check with a CPA to be sure, but my understanding is that when you have interest accruing to reserve funds, that stays within the reserve account, and it just adds to the pool of funds that you've already got. That's how it should be. I mean, most of the communities out there are behind in their reserve funding anyways. So if you have the benefit of earning some interest on those funds, just keep it in the fund. Don't start using that money for other things. All right, let's see. I've got about maybe 5 or 10 minutes left. You guys are asking questions at a rate faster than I can answer them. So I appreciate everybody who's staying on, and apologies if I don't get to your question, but I'm trying to go as fast as I can here. If you conduct a reserve study, compare to the reserve balance and determine the percentage is low, is it appropriate to charge an assessment to increase the percentage if there isn't a specific purpose identified? That's a very good question. I've gotten that over the years. I think it's wise to try to do that, but it really depends on how low is low. I mean, if you're 4% funded and the writing is on the wall that, you know, whether you don't need an assessment right away, but you're going to need one within the next 3 to 5 years as some project comes due, then I would say, yeah, you might as well pass that assessment now and hopefully avoid or minimize the risk of a larger one down the road. So it may not be for one particular project. It might just be, hey, look, we've been waiving or partially funding for many years. We don't have a lot of money set aside. No, there's not some, you know, 5-alarm emergency right now that we need to pay for, but we look out the next several years, there will be those things coming. We should pass a special assessment now. I always think of a special assessment as a form of a catch-up contribution that basically is making up for lost time, right? So if you've got a group of owners who have lived in the building forever, and they've been the ones who have enjoyed those budgets over the last however many years that have minimal reserves, and now you're running out of time on the lifespan of these other components, by all means, I think it's fair to charge those same people a special assessment to make up for the prior years when they weren't budgeting enough. But again, if you're 70% funded and there's no real major issues going on, I don't think there's a need to pass a special assessment just to get up to 90 or 100 just because. I think that would be excessive. I like this question. Is there anything that can be done to those board members who kick the can down to us? Boy, that's a tricky one. I guess a better question for an attorney. You know, if you're really serious that there was some mishandling of funds or something untoward was being done, you know, there's forensic accounting firms you can hire that will maybe look back and see, was there, you know, some foul play at stake here? But that's usually not the case. I think what people need to remember is that it's usually not the board members who are kicking the can. It is the entire membership, right? The board cannot vote by itself to waive reserve funding. That's done at the membership level. So it may not just be board members. It may be prior generations of owners who just said, look, we don't want to pay for this stuff and we're not going to be here when it happens. So too bad. And now the people who live there now get stuck holding the bag for those things. That's unfortunate and difficult, but you know, unless there's a legal action to take on those prior board members, I'm not aware of any other really recourse. Okay, let's see. If there is, say, $20,000 in the reserve fund for plants and we don't need it, can that money be moved to fund another item? So it depends on whether or not you have straight line or pooled reserves. If you have straight line reserves, what we call the component method of reserve funding, anytime you're going to move money from one place to another, that has to be approved by the membership. So you would have to say, you know, if you have plant reserves and roof reserves, you would have to get a vote to move money from one place to the other. If you have pooled reserve funds, there's no vote needed. You just have a collection of money that can be spent on any item on the list. So assuming that you've got, you know, plants or plant material on your reserve list and some other else that has a bigger need, there actually is no money moving around. It's all part of one big pool of funds. But if it is straight line, then you would have to get the owners to vote. Okay, well, I like this. Any plans to produce a video targeted to owners who don't understand? This is good for the savvy ones, but a direct appeal to owners who have been waiving forever would be helpful. First of all, I appreciate the compliment, but yeah, I've tried to make this as approachable and user-friendly as possible. There's a lot of great content on there on our website and others, just, you know, extolling the virtues of having reserve funds. But I think it's very tough to convince somebody of something that they just don't want to hear, or just, you know, it's going to hit them in the pocketbook and they have kind of decided in advance that they don't like it. You're going to have a hard time getting through to those people. But I think the encouraging thing about this new Senate bill and these new legislative requirements is that it's leveling the playing field for everybody, right? I think up until now, you could argue that it was almost it was unfair, but it was cast associations in a bad light for doing the right thing, right? If you were the only building on the block that the dues were $800 a month and everybody else was paying $400 a month, but your building was the only one that was actually funding their reserves, unless people really dug down and appreciated the value of doing that, you would be seen as a more expensive building, and maybe that's a turnoff to people who want to buy a condo. The fact that the state is now going to raise the playing field and make everybody fund their reserves is a good thing, right? And that will make sure that good actors are not being punished for making responsible choices. So I think, if you've got owners out there that are obstinate and just don't want to hear it and don't care, it doesn't really matter what I say or what you say. The law is going to be that you have to start funding reserves. So that's the bottom line. Pooled reserves a good idea? Yes, absolutely. We've got a whole nother class on that subject. I'll kind of just leave it at that. I think we'll work with Campbell to produce that sometime later this spring. But yeah, the other class that I teach is basically an examination of straight line funding versus the pooled method. And I think if you watch that class, you'll come away with hopefully being convinced that pooled funding is by far the way to go. I'll tell you, outside of Florida, it's not even a question. Everybody else in the country, the default mode has been pooled reserves for decades. Florida is the only place, and we have clients in all 50 states, so I can say this with authority, Florida is the only place that anybody really uses the straight line method anymore. It has been antiquated for many, many years. There's no reason not to pool your reserves. Okay. All right, just got a couple of minutes left, so I'm going to scroll through the list. Again, still 49 open questions, so I apologize to you guys who I have not covered here. I'm going to try to go through maybe some of the shorter questions that I can answer quickly. Let's see. Here's one. I think I heard you mention that there are a lot of condos canceling, meaning dissolving as a 718 condo. Yes. So the term for this is called condo termination. And it basically means that, imagine a condo building and they have just decided that we don't want to be a condo anymore. We are going to effectively relinquish our ownership. We're going to sell this property as a group to a developer who is either going to keep it, maybe turn it into an apartment building, or knock it down more likely and build something new in its place. The real tricky part here is that it does not require 100% of the owners to be on board with that plan. I think the voting threshold is either 85 or 90%. The point is it's still a majority, a strong majority, but you can have holdouts in a building that absolutely do not want to sell their condo, and they can be overridden by everybody else. So we've had this happen. We've had clients that have said, look, we are in such a financial hole, but the land we sit on is very, very valuable. We can sell our building to somebody else who will demolish it, but the money we will take from those proceeds is worth it. And it's a good deal for the developer because, if it's an oceanfront location, guess what? There's not a lot of that land left. They will build something new and make their money back. So that is a condo termination. And my prediction is you're going to see a lot more of that, especially on the coast, especially with older properties, as they realize that they are in a financial hole that they just can't climb out of. So that's probably a good enough place to stop. Ashley, I'll turn it back over to you. Just want to say thanks again for everything. And thanks again. It was a great session today. Thank you.
Awesome. Thank you so much, Will. Really, really appreciate it. Thank you, everybody, for joining us. Again, just to reiterate, I will be emailing out the presentation, a link to the video recording of this webinar after. I'll be sending Will the attendee list to get you guys your credits. So thank you guys so much for coming, and thank you, Will, for conducting the course. It was great.
As always,
Have
see
a
you next
great day,
time.
everyone.
Thanks, everybody. Bye-bye.
Thanks for watching. For more great educational content, click the subscribe button now.